Welcome to the deep dive. Today, we're getting into some fascinating material from a book called The Simple Path to Wealth.
Right. And it's positioned not just as, another finance book. It feels more like a personal guide.
Exactly. A roadmap to financial independence, and maybe more importantly, a life with more freedom. It actually grew out of letters the author wrote to his daughter.
Yeah, and that origin story, I think, really shapes the whole approach. It makes the core message pretty clear. Sound investing doesn't have to be this incredibly complicated thing.
Right. The book basically says, look, money is a powerful tool. You've got to learn to handle it, or, well, it'll handle you.
That's the crux of it. Understanding it, making deliberate choices. That's the simple path they're talking about.
And you can really feel the effort to make it, well, accessible in these excerpts. It avoids all that dense financial speak.
Totally. Uses analogies that actually make sense, like the beer and foam one we might get into, and lots of personal stories.
Yeah, it makes complex stuff feel much more, relatable, almost enjoyable, which is saying something for a finance topic.
Definitely. The fact that it started as blog posts people really connected with and then became a book kind of proves that style works.
So for this deep dive, our goal is really to pull out the key ideas for you, the listener. What are the core concepts from this material?
We want to help you understand what this simple path actually involves and maybe, just maybe, how you could apply some of it.
All right, let's dig in. Where does it all begin?
Well, it starts right at the foundation, personal responsibility. The book makes it super clear right from the get-go. You and only you are responsible for your financial choices.
Even with everything going on externally.
Yeah, I mean, it acknowledges external factors, sure, but the power to decide how you earn, how you save, how you spend that rests with you. It's about taking ownership.
Yeah, so starting from that point of ownership,
Yeah.
what's the first action?
The very next step, the cornerstone principle, is incredibly simple. Save a portion of every single dollar you earn.
Classic advice, but it sounds like they put a real emphasis on the rate of saving.
Oh, absolutely. It's not just about saving something. It's about the power, the accelerating force of a high savings rate.
Right. The more you save, percentage-wise.
The exponentially faster you reach that goal of financial freedom, the book actually suggests saving 50% of your income.
50%? Wow, that sounds ambitious.
It's presented as perfectly doable, especially if you manage to avoid debt. And there's this twofold benefit they highlight.
Okay.
One, you're actively learning to live happily on less money, which is a skill in itself. And two, at the same time, you have way more capital available to invest and grow.
So you're training yourself while fueling the engine. That makes sense.
Exactly. It's behavior modification and capital accumulation working together.
This idea of getting free faster,
Yeah.
it ties into that phrase they use, right? The FU money.
Yes, and it's such a memorable term, but importantly, the book explains it doesn't necessarily mean having enough to retire on forever, not at first anyway.
So what does it mean then?
Often it's just having enough cushion, enough financial breathing room to step away from a bad situation, a job you hate, a bad boss, whatever, even just for a little while.
Okay, so it's about options. There's a story about the author's first experience with this.
Yeah, it's a great illustration. He was 25, earning just $10,000 a year, which was, not much even then. But after 2 years, he'd saved $5,000.
$5,000. Okay.
Seems small, right? But for him, it was huge. It gave him the confidence to ask his boss for 4 months of unpaid leave to travel Europe.
Unpaid leave. How did the boss react?
Initially, scoffed. Said it wasn't possible, but because the author had that $5,000, he wasn't dependent on the next paycheck. He wasn't afraid to push back or even walk away.
Ah, so the money gave him leverage.
Exactly. He got the unpaid leave, he got his trip, and he even negotiated better vacation time going forward. He said that $5,000 bought him freedom, and he vowed, quote, never be a slave again. It wasn't the dollar amount, it was the power it gave him.
That's a powerful realization early on. And he used this FU money concept again later.
Oh yes, several times. Quit jobs, took breaks between careers, bought a business, traveled. Sometimes without a specific plan, just wanting the time.
Your common thread being choice.
Precisely. The freedom to choose what he wanted to do, not what economic necessity forced him to do.
And this connects to family life too, doesn't it?
It does, quite profoundly. His daughter was born during a period when neither he nor his wife was working a traditional full-time job.
Wow.
He talks about spending just hours and hours with her as a toddler, watching The Lion King over and over, building towers, those everyday moments. He felt that time, made possible by their financial position, built this incredibly strong foundation for their relationship.
That adds a whole different dimension to it.
And it leads to this really pivotal moment when his wife was thinking about quitting her job to be a stay-at-home mom. She liked her work, worried about, losing that identity or contribution.
Understandable concern.
His response really sums up the whole philosophy. He basically said, look, we have FU money. If you kept working, what could we possibly buy with that extra money that would have more value than you being home with our daughter?
Oof. That puts things in perspective. What did they decide?
She quit, and he calls that decision the best purchase they ever made. And here's the amazing part. Even during a 3-year stretch where they both had significant time out of the workforce, their net worth still grew.
Seriously, how?
Investments continuing to compound, living below their means. It was at that point they realized they'd actually moved beyond just FU money and had achieved full financial independence. Their assets were now enough to cover their life expenses.
So the ultimate point of money, according to this path, is freedom.
Absolutely. Freedom is the most valuable thing money can buy. Freedom to control your time, choose your work for people you respect, or not work at all.
And the flip side, people without that freedom.
They're described as being trapped, especially by debt. The book uses this striking image. People living paycheck to paycheck or carrying debt are like slaves with stouter shackles.
Which leads us squarely into the topic of debt.
Yeah.
The book does not hold back here.
Not at all. It calls debt a vicious, pernicious destroyer of wealth-building potential. Plainly states it has no place in your financial life. Zero tolerance.
That feels pretty countercultural, doesn't it? So much of society runs on debt.
Exactly. The author seems genuinely baffled that more people don't see how destructive it is, that they seem almost happy to take it on, but he spells out the downsides very clearly.
Okay, like what? Financially, obviously.
Right. Financially, it just eats away at your lifestyle. A big chunk of your income is gone before you even see it, just servicing interest. Money that could be saved, invested, enjoyed, poof, gone.
And that ties you to your job, right? You have to make those payments.
Enslaves you to your income source, yeah. Massively limits your choices, your ability to pursue goals, or even just take advantage of opportunities that come up.
But it's not just the financial side, is it? The book talks about the psychological impact, too.
Oh, absolutely. It describes the stress of debt as feeling like being buried alive, the emotional weight, shame, guilt, feeling helpless, lonely.
Sounds heavy.
And that stress isn't just unpleasant, it's damaging. It narrows your focus, can lead to bad coping habits, drinking, smoking, sometimes even more spending, ironically. It keeps you stuck looking at past mistakes and present pain.
So debt kind of traps your mindset, too.
Yeah, the book argues it hardwires negative attitudes and habits, making it even harder to break free.
There's a story about his own early experience with debt.
A very relatable one about getting his first credit card. He was excited, bought $300 worth of stuff, thinking the $10 monthly payment was amazing.
Sounds familiar.
Until his sister and then his dad pointed out the 18% interest rate, his dad's advice stuck with him. If it sounds too good to be true, it is. That early lesson seems to have fueled his lifelong aversion to consumer debt.
Makes sense. What about specific types of debt? Even the ones people sometimes call good debt.
Yeah, it tackles those too. Student loans, for instance. The argument presented is that the easy availability of these loans massively distorted college costs.
And so?
It compares inflation from 1970 to 2014. General prices went up about 6 times, but the cost of a 4-year state college, 33 times.
33, that's staggering.
And the book links this directly to the flood of loan money. Universities could suddenly afford huge building projects, fancy dorms replacing cheap housing, massive increases in administrative salaries.
Because the money was available via loans, they could charge more.
Precisely. And the culture shifted. Living super cheaply became harder, maybe less socially acceptable. Sushi lunches funded by loans instead of rice and ketchup. Higher ed morphed into expensive job training, partly to justify the debt load.
Yeah, what about mortgages? That's the classic good debt, right? Building equity.
The book acknowledges that, but warns that easy mortgage money tempts people into buying way more house than they need or can truly afford, often nudged along by the real estate industry.
So the advice for someone on this path is,
Seek the least house you genuinely need, the most modest option that works for your life, not the biggest one the bank says you can afford. It's about minimizing that debt burden.
all right, so the stance is clearly anti-debt. But what if you already have debt? What's the guidance then?
It's absolutely unequivocal. Paying it off becomes your number one financial priority, especially high-interest debt. Nothing else matters more until that's gone.
Total focus. Is there a way to prioritize which debts?
Yeah, a simple guideline based on the interest rate, less than 3%. Maybe pay it off slowly, consider investing the difference, between 3% and 5%. It's a gray area. Do what feels right for you. Pay debt or invest.
But over 5%.
Pay it off ASAP, non-negotiable, attack it relentlessly.
And the plan for doing that?
It's methodical. Step 1, list out every single debt you have. Step 2, cut all non-essential spending. Be ruthless. Those small daily things add up hugely. Free up every dollar.
Okay, list debts, cut spending. Then,
Step 3, rank the debts by interest rate, highest to lowest. Step 4, pay only the minimum on all debts except the one at the very top of the list, the highest interest rate.
and put all the extra money towards that top one.
Every single spare dollar goes to attacking that highest rate, the biggest debt flame. Step 5, once that top debt is totally gone, take all the money you were paying towards it, minimum plus extra, and add it to the minimum payment on the next highest rate debt.
Like a snowball effect, but focused on interest rates first.
Exactly, sometimes called the debt avalanche method. You keep repeating that process, rolling the payment amount down the list until all the debt is gone.
And then, what happens to that money once the debt is paid off?
That's the powerful transition. You take that same chunk of money you were using to kill debt and immediately redirect it into your investments. The satisfaction shifts from watching debt disappear to watching your wealth start to build.
Does the book acknowledge any valid uses of debt, like for a business?
Briefly, yes. It concedes that astute use of some debt, maybe business debt, is possible, but considers it complex, risky, and outside the scope of this simple path. The strong recommendation for personal finance remains: avoid it.
So, wrapping up this whole foundation section, for you listening, the intense focus on debt isn't just numbers. It's about control.
It's absolutely about control and options, making sure your values drive your choices, not interest payments. It's about clearing the decks to actually build wealth and reclaim your freedom.
Okay, so with that foundation, hopefully laid high savings, no debt, we can talk about the engine for actually growing wealth.
Right, putting that saved money to work. Which brings us to stocks, index funds, and maybe the trickiest part, market psychology.
This section kicks off with a big question. Can everyone actually retire a millionaire, even on an average income?
And the answer given is interesting. It's a split verdict, based purely on the math, the power of compounding. For a middle-class person saving diligently over time, the answer is yes. But based on observing how people actually behave and the constant pressure from marketing and consumer culture, the realistic answer is probably never going to happen for most.
Let's look at that math first, because it sounds pretty persuasive.
It is. The book often uses the S&P 500's historical average annual return, including dividends, which was around 11.9% for the period 1975 to 2015 they reference.
Okay, nearly 12% a year on average.
Using that figure, they show that if you had invested just $12,000, one lump sum back in 1975,
12,000.
by 2015 it would have grown to over $1 million.
Wow. Just from compounding.
Just from letting the market work over 40 years, it really highlights the power of time.
So mathematically possible. Yeah. What about the other question they pose? Financial independence.
Right, which they frame as maybe more achievable and meaningful. Can everyone reach FI? They point to examples from blogs like Mr. Money Mustache or Early Retirement Extreme.
People who did it quickly on less income.
Exactly. People living very frugally, maybe on just $7,000 a year, who calculated they only needed around $175,000 invested to be financially independent using that 4% withdrawal rule.
So it can be done, the numbers work out. What's the big roadblock then?
Those marketing forces again, constant pressure to consume, to buy more, newer, better things. And if you can't afford it, easy credit, loans, debt.
It obscures the simple path.
Totally. The book argues it's deadly to your wealth because it makes the simple alternative, live on less, save consistently, invest simply, seem impossible or undesirable. You really have to consciously question what society deems a necessity.
Before jumping into stocks, there's a mention of level on thinking about money.
Yeah, a quick revisit. Do you see money mainly as something to spend now, or as capital, something to invest and grow? The rich mindset, in this view, focuses on putting money to work to make more money.
Okay, so with that investor mindset, how should we think about owning stocks, especially index funds? It's not just numbers on a screen.
Definitely not. The book really pushes you to understand what you actually own. It's not just slips of paper or fluctuating data points.
So if you own something like VTSAX, Vanguard's total stock market index fund.
You own a small piece of literally thousands of U.S. companies, around 3,700 different businesses at the time the book was written. The giants, the small startups, everything in between. You own a slice of the entire U.S. economy.
And this ties into the self-cleansing idea.
Exactly. It's a crucial concept for long-term investing. Some of those 3,700 companies will inevitably fail or fade away, but new ones are constantly starting, growing, going public. The index automatically drops the losers and adds the winners.
So you don't have to pick them.
You don't have to guess. You just own the whole dynamic system, which is constantly refreshing itself. The successful companies have unlimited upside, and you benefit from that collective growth.
Is there a way to use this for security, not just growth?
The book mentions a sort of theoretical extreme for absolute security, which is different from a smooth ride, mind you. It suggests holding 100% VTSAX and just living off the dividends it throws off, maybe around 2% historically. The idea is the underlying businesses are productive, even if the stock price jumps around.
Speaking of jumping around, volatility. The book is very direct about this.
Very direct. Doesn't sugarcoat it at all. Lays out some core truths you have to accept. 1, you cannot time the market. Trying is pointless. Ignore the gurus. Ignore the daily noise.
Okay, impossible to time. What else?
2, the market always goes up over the long term. 3, it is always a wild, bumpy, unpredictable ride along the way.
Why is timing so impossible? Is it just hard?
It's worse than hard. The book argues it's counter to our wiring. Our psychology makes us do the exact wrong thing. We feel euphoria and buy when prices are high, and we feel panic and sell when prices crash low.
Buy high, sell low, the classic mistake.
And academic research apparently confirms this. We're just not emotionally built for volatile markets without conscious effort and awareness.
What about all the predictions then? The experts on TV?
Dismissed as useless and distracting noise. They predict booms and busts constantly for ratings, for excitement, to sell newsletters or services. Listening and acting on it is positively dangerous for a long-term investor.
The book uses history to back this up.
Yeah, looking at long-term charts like the Dow Jones from 1900 onwards, it shows this relentless upward trend despite world wars, depressions, crashes, everything. The numbers are stark Dow at 250, 60 years ago, near 18,000 by 2015. S&P 500, around 500 just 20 years before 2015, over 2,000 by then. History shows recovery and growth.
So, accepting that volatility and crises are normal, what's the advice?
It's blunt. Toughen up, cupcake, and cure your bad behavior.
Oh, okay.
Sounds harsh, but it's really a call to action against your own instincts. Recognize that your emotional reactions are likely counterproductive. Overcoming that makes investing simpler and gets you better results.
What specific market behaviors should we expect then?
1, crashes happen. They're normal. The book lists them. 74, 75, the inflationary late 70s, early 80s, Black Monday, 87, early 90s recession, the dot-com crash, 9/11 impact, the 2008 global financial crisis.
Okay, they're part of the deal.
They've happened. They will happen again. 2, the market always recovers. If it didn't, well, we'd probably have bigger problems. But history shows it does. That $1,000 in the S&P 500 in 74 becoming nearly 90K by 2015 proves the point. Your long-term wealth depends heavily on what you do during the crash.
Panic or hold, or even buy more.
Exactly. Hold, ideally add more if you can. 3, the long-term trend is always up. 4, stocks have been the best performing asset class over time. 5, Expect just as many disasters in the next decades. It'll feel scary every time, the noise will scream sell, only those who stay the course prosper.
So the action plan is build mental resilience, ignore the noise, ride out the storms, and keep adding money, especially during downturns. Don't think this time is different.
That's the core message for handling volatility. Crashes are opportunities in disguise for the long-term investor. It's hubris to think the world ends on our watch.
This explains why most people apparently lose money in the market, doesn't it?
Precisely. Reason one is trying to time it, driven by fear and greed, leading to buying high and selling low.
What's reason two?
Trying to pick winning stocks or winning fund managers. The book argues this is basically impossible for almost everyone, even the professional.
The author had experience with this.
Yeah, he worked at an investment research firm, learned quickly that analysts don't have magic information that would be insider trading, which is illegal. Market-moving news gets priced in instantly. Even CEOs can't predict their own company's future perfectly. He realized his early belief in his own stock-picking skill was just enormous hubris.
Humbling.
Very. He concluded most Wall Street fortunes are made from commissions and fees, not successful investing. Humility is key.
Okay, timing is bad, picking is bad. Reason three.
Believing that actively managed mutual funds can consistently beat simple index funds, the data just doesn't support it, especially after fees.
Fund companies have ways of making it look like they do.
Yeah, the book mentions tactics like launching tons of funds, then quietly closing or merging the ones that fail so only the temporary winners remain visible. The quote is biting. Lots of money to be made with actively managed funds, just not by the investors.
Ouch. And reason four for losing money? Something about foam.
Yes, the beer and foam analogy, it's really helpful. Picture pouring a beer badly, mostly foam, little actual beer.
Okay.
The stock market is like that. The beer is the real value, the underlying businesses, making products, earning profits, growing over time. The foam is the frenzy, the daily price swings, the trading, the noise on CNBC driven by emotions, news, rumors.
So the foam is the volatility, the day-to-day market action.
Exactly. It's hard to tell how much of any day's price is real value, beer, versus just sentiment, foam. That's why prices jump around seemingly irrationally, why experts disagree. Traders try to profit from guessing the foam.
But for the long-term investor,
Focus on the beer. Own the underlying businesses through a broad index fund. Ignore the foam. That's what drives wealth over decades.
so putting it all together, the market's wild, crashes are normal, our brains work against us. But indexing is the solution if we can control our behavior.
That's the synthesis. Indexing works because it captures the growth of the whole market, self-cleansing, avoids the futile game of timing or picking, and is incredibly low cost, letting your money compound for you. Trying to beat the market, either yourself or by picking a manager, is like asking, am I Warren Buffett? Probably not. Stick to the reliable index.
Okay, that makes a strong case for the what and why of indexing. Now, how do you actually structure this? Portfolios.
Exactly. Moving from the concepts to practical application. How do you use these ideas to build and then preserve wealth? The book offers two main portfolio structures, mostly using VTSAX for the stock part.
Let's start with the first one, the wealth accumulation portfolio.
Right. This one is explicitly designed for people who are in the building phase, maybe younger, focused on getting to that FU money stage as fast as possible. It bets heavily on stocks, the best performing asset class in history.
So it requires that mental toughness we talked about
Yeah.
to handle the volatility.
Absolutely. Gotta have your mind right to ride out the storms. And it challenges that old saying, don't put all your eggs in one basket.
Oh. What's the alternative advice?
For the accumulator, the author flips it. Put all your eggs in one basket and forget about it.
Forget about it.
Well, not literally forget you own it, but forget about watching it obsessively day to day. The irony is the more you watch and tinker, the worse you tend to do. The advice is behavioral. Pick your simple, diversified basket, VTSAX. Keep adding money consistently, then ignore the noise. Do that and you'll likely wake up rich.
And the recommended basket is VTSAX, Vanguard Total Stock Market Index Fund.
That's the primary recommendation because it holds, basically everything in the US market, thousands of companies, super diversified, self-cleansing, and crucially, ultra low cost, so fees don't drag down your returns.
Does research back up this 100% stock approach for growth?
Generally, yes. Studies show that over long periods, 100% stocks tends to deliver the highest returns. The higher short-term risk is rewarded. The main risk isn't the asset class itself, it's the investor bailing out during a downturn psychological failure.
Is there any middle ground mentioned?
Yeah, it notes that some studies suggest adding a small amount of bonds, maybe 10–25%, could slightly improve risk-adjusted returns and reduce volatility a bit compared to 100% stocks. The author doesn't argue against it if you're okay with the added complexity of rebalancing.
And the historical examples really drive this home.
They do. Investing just $200 a month from 1975 to 2015 in the S&P 500 grew to over $1.5 million. A single $10,000 investment in 75 became almost $900,000 by 2015, despite all the crashes. It just hammers home. Stay the course, keep adding.
Okay, that's the accumulation phase. What about later? The wealth preservation portfolio.
Right. This is for when your goals shift. Maybe you're nearing retirement, already FI, or just temperamentally can't handle the wild swings of 100% stocks anymore. The priority becomes protecting what you have and smoothing the ride, even if it means lower returns. Basically, sleeping well at night.
What does that portfolio look like?
The author shares his own as an example. Roughly 75% stocks, VTSAX, about 20% bonds, using VTSAX, Vanguard's total bond market index fund, and maybe 5% in cash.
Okay, so introducing bonds. What's the role of VTSAX here?
It provides some income, significantly dampens the portfolio's volatility compared to all stocks, and can act as a hedge against deflation.
And the cash.
Just for liquidity, held in a regular bank account for easy access to cover near-term expenses. But the key is these percentages are flexible. You tune them to your comfort level. More bonds mean a smoother ride, less growth. More stocks mean more potential growth, more bumps.
So choosing that mix, the asset allocation, it comes down to personality and goals.
Temperament and goals, exactly. And importantly for the simple path, how much effort you want to put in. Financial geeks might enjoy tinkering, but most people want simplicity.
How does effort play in?
Well, 100% VTSAX is dead simple. Add money. Done. Adding bonds introduces the need to rebalance.
Right, rebalancing. Can you explain that again?
Sure. It's just periodically bringing your portfolio back to your target percentages. Let's say you want 80% stocks, 20% bonds. If stocks have a great year, you might end up at 85% stocks, 15% bonds. Rebalancing means selling 5% of your stocks and buying 5% more bonds to get back to 80-20.
And you do the opposite if bonds outperform.
Exactly. Sell some bonds, buy some stocks. The book suggests doing it maybe once a year or after a really big market move, like 20% up or down. And it's best done in tax-advantaged accounts if possible to avoid capital gains taxes on the sales.
Is it hard to do?
Online, it's usually pretty straightforward, takes maybe a few hours a year, but the crucial thing is you have to actually do it consistently if you choose an allocation with multiple asset classes.
Is there a clear winner between, say, 100% stocks and 80-20?
The book kind of downplays the difference over the very long term. Studies rely on assumptions. The real-world difference might be small and unpredictable. Simplicity really favors 100% VTSAX during accumulation for many.
What about investing internationally? Is VTSAX enough?
The author leans towards simplicity again. VTSAX holds big U.S. companies that do business globally, so he feels that provides enough international exposure for this path. But he does mention Vanguard has dedicated international funds if you feel you need more direct diversification.
Okay, let's dive a bit deeper into bonds, since they're key for the preservation stage. Are they truly risk-free?
Not at all. The book highlights key risks. Default risk, the borrower doesn't pay back. Interest rate risk, if rates rise, the value of your existing lower rate bonds falls. And inflation risk, rising prices erode the purchasing power of your fixed bond payments. This is often seen as the biggest risk.
But using an index fund like VBTLX helps with some of that.
Yes, significantly. Especially default risk, because you're diversified across thousands of different investment-grade bonds. VBTLF is positioned as the simple, effective way to hold bonds if you choose to.
It mentions bond ratings.
Briefly, yeah. Agencies like Moody's or S&P rate bonds from AAA safest down to D, default. Lower rating means higher risk, so they have to offer higher interest to attract buyers. VBTLX sticks mostly to higher quality bonds.
And inflation risk is the big one.
It's a major concern for bondholders, especially with long-term bonds, as inflation eats away at the real value of those future payments. Interest rates usually have some expectation of inflation built in.
But the book brings it back to simplicity.
Yes. The final point on bonds is basically there are tons of different types, but for the simple path, just understanding and potentially using a total bond market index fund like VBTLX is all you really need. Don't get lost in the weeds.
Okay, so we have the engine stocks indexing mindset. We have the structures, accumulation, and preservation portfolios. Where do these investments actually live? The buckets.
Exactly. Section 4 is all about the containers. And this is a super important distinction the book makes, one that confuses a lot of people.
I think which is?
Things like your 401k, an IRA, a 403b, TSP. These are not investments themselves. They are just the accounts, the different types of buckets that hold your investments, like your shares of VTSAX or VBTLX.
Got it. Buckets, not investments. What kinds of buckets are there?
Two main types, the ordinary or taxable bucket, and then the various tax-advantaged bucket.
Let's start with ordinary taxable. That's just a regular brokerage account.
Pretty much, it's the default. No special tax breaks. Any dividends, interest, or capital gains distributions your investments generate inside this bucket are taxed each year.
So you want investments that don't generate much annual tax in here.
Ideally, yes. It's best for tax-efficient investments. Things like stock index funds, VTSAX being the prime example. They tend to pay mostly qualified dividends, taxed lower, and don't trade frequently, so they rarely spit out taxable capital gains distributions, unlike many actively managed funds.
What's the main advantage of this taxable bucket?
Flexibility. The money is accessible anytime for any reason, no penalties, complete liquidity.
Okay, then the tax advantage buckets, why do these exist?
Primarily, the government created them to encourage people to save for retirement by offering tax benefits.
But there's a key clarification here about eliminating taxes.
Yes, and this is critical to understand. Except for Roth accounts regarding growth and qualified withdrawals, these buckets generally don't eliminate taxes, they defer taxes. You'll pay the tax eventually, just later, usually when you withdraw the money in retirement. Burn that distinction into your brain. Deferral, not elimination, mostly.
And these tax benefits come with strings attached.
They do. Usually penalties and taxes if you take money out before a certain age, like 59 and a half. And for most types, again, except Roth IRAs, the government eventually forces you to start taking money out via required minimum distributions, RMDs, typically starting after age 70 and a half. They want their deferred tax revenue.
So strategically, what kind of investment should go in these tax advantage buckets first?
You prioritize putting your tax inefficient investments here, things that generate a lot of taxable income each year. Bonds, like VBTLX with its interest payments, are a classic example. Also CDs, REITs, maybe some actively managed funds that churn assets and generate gains. Holding them here shields those annual payouts from immediate taxes.
What about VTSX? It's tax efficient, so does it go here too?
Yes, absolutely. While VTSAX is fine for a taxable account, any investment benefits from tax deferral or tax-free growth. So you definitely want to fill up your tax advantage space with VTSX as well after you've sheltered the less efficient stuff like bonds.
Okay, let's look at the specific types of tax advantage buckets. 401k, 403bs, TSPS.
These are employer-sponsored plans. Usually your contributions go in pre-tax, meaning they lower your taxable income now, the money grows tax-deferred, then you pay ordinary income tax on withdrawals in retirement.
And the catch.
Penalties for early withdrawal before 59.5, R&Ds after 70.5. But the huge, unmissable benefit is the employer match. If your employer offers to match your contributions up to a certain percentage, you must contribute enough to get that full match. It's 100% free money. Don't leave it on the table.
Fees can be an issue in these plans, though.
They can vary a lot. Always check the plan documents and choose the lowest cost index fund options available. When you leave the job, you can usually roll the money into an IRA you control, which often gives you better, cheaper choices. TSPs for federal employees are an exception, often worth keeping due to incredibly low fees.
What about the Roth 401k?
That's a newer option some employers offer. Contributions are after tax, no deduction now. But the growth is tax-free, and qualified withdrawals in retirement are tax-free. Big difference from a Roth IRA, though. Roth 401ks do have RMDs, no income limits to contribute, though.
Okay, moving on to IRAs, individual retirement arrangements. These are separate from work.
Right, you open these yourself, gives you full control over the investment company, Vanguard recommended again for low costs, and your investment choices. But there can be income limits affecting eligibility or deductibility for some types.
Like the deductible IRA, traditional IRA.
Yes, the traditional IRA, where contributions might be tax deductible now depending on your income and whether you have a retirement plan at work. Earnings grow tax deferred, withdrawals are taxed in retirement. Same age rules. Penalties before 59.5, RMDs after 70.5. Often makes sense if you think you'll be in a lower tax bracket later.
And the Roth IRA. This seems to be a favorite.
It has some amazing advantages. Contributions are after tax, no deduction now, and there are income limits to contribute directly. But the growth is tax-free, and qualified withdrawals after 59.5 are completely tax-free.
Yep.
Huge benefit. You can withdraw your original contributions anytime, tax and penalty-free.
Contributions only.
Contributions, yes, and converted amounts after 5 years. Plus, penalty-free withdrawals for first-time home purchase or education costs. And the kicker, and no RMDs ever on your own Roth IRA. You never have to take money out during your lifetime.
Wow, that's powerful. What about the non-deductible IRA?
Mentioned briefly, but generally seen as less useful for the simple path. You contribute after tax, only the earnings grow tax deferred, it adds tracking complexity, not usually the first choice if you're eligible for other types.
So putting it all together, what's the strategy for using these buckets?
Prioritize the tax-advantaged ones first. Max out that employer match free money. Then contribute as much as you possibly can to the others, aiming to hit the annual limits. Put tax-inefficient stuff like bonds, VTSAX, in these shielded accounts first. Then fill the rest of the space and your taxable account with tax-efficient stuff like VTSAX.
The book uses an example to show this.
Yeah, a 24-year-old earning $70K. If they save 24%, 16.8 cents a year. First, contribute to the 403B to get the full match, invest in VTSAX equivalent. Second, max out a deductible IRA, VTSAX. Third, put any leftover savings into the ordinary taxable bucket, VTSAX.
Okay, layering them. What if they save more, like 50%?
If they save 50%, $35 here. First, max out the entire 403B employee contribution limit. Second, max out the deductible IRA. Third, the significant amount remaining still goes into the ordinary bucket. It shows how a high savings rate lets you fully utilize the tax advantage space and build a sizable taxable account quickly.
And always check the current rules and limits, right?
Absolutely. Tax laws change constantly. These are just the principles.
Foundation engine, buckets. We've built the wealth conceptually. Now, the payoff. Managing it, spending it.
Right. Section 5 covers the later stages, dealing with RMDs, using HSAs strategically, and actually spending the money you've accumulated. First up, RMDs, the ugly surprise.
Required minimum distributions. Starting around age 70.5, the government makes you take money out of most retirement accounts.
Yep. Traditional IRAs, 401ks, 403bs, basically anything where you got a tax deduction up front or tax-deferred growth, except Roth IRAs. Uncle Sam wants his deferred taxes back.
And you have to take it.
You do. And the penalty for not taking enough is severe, 50% of the amount you missed. So you don't want to ignore this. Brokerages like Vanguard can usually help automate it.
What's the potential problem with RMDs?
For people who saved a lot, the required withdrawal amount can be quite large, potentially pushing them into much higher tax brackets in retirement than they expected.
Is there a way to manage that, especially for early retirees?
The key strategy discussed is the Roth conversion ladder. This is especially relevant if you retire early or have years with low taxable income before RMDs kick in.
How does it work?
You strategically convert chunks of money from your pre-tax accounts, like a traditional IRA or rolled over 401k, into a Roth IRA. You have to pay income tax on the amount you convert in the year you do it.
Why would you choose to pay tax now?
The idea is to do these conversions during your low-income years, paying tax at potentially much lower rates than you might face later when RMDs force large withdrawals. It reduces your future RMDs and moves money into the Roth bucket where it can grow and be withdrawn completely tax-free later. It's about optimizing your lifetime tax bill.
Okay, interesting strategy. What about health savings accounts, HSAs?
These are presented as a really powerful tool, often paired with high-deductible health plans, HDHPs. The plans have lower premiums, but you pay more out of pocket initially. HSAs help cover those costs.
But they're more than just a healthcare account.
Much more, potentially. They have a unique triple tax advantage. 1. Contributions are tax-deductible or pre-tax. 2. Money grows tax-free. 3. Withdrawals are tax-free if used for qualified medical expenses.
Duple tax-free. That sounds good. What's the investment angle?
Here's the crucial part. You are not required to spend the HSA money on medical bills as they occur. You can pay those bills with other money, out of pocket, and save the receipt.
And leave the HSA money invested.
Exactly. Invest it, maybe in VTSAX, like the book suggests, and let it compound tax-free for years, even decades. Later on, you can reimburse yourself tax-free from the HSA using those old saved receipts.
So it becomes like another retirement account.
A very flexible one. After age 65, you can withdraw HSA money penalty-free for any reason. It's just taxed like a traditional IRA, if not for medical. Before 65, non-medical withdrawals face tax, plus a 20% penalty.
Any RMDs on HSAs?
Currently, the law is silent, which is a potential advantage. The bottom line, if you have access to an HSA, fund it. Used strategically, it's like a supercharged Roth traditional IRA hybrid.
All right, now the big moment.
Mm-hmm.
Actually spending the wealth. The 4% rule comes up here.
Yes, this marks the transition. Your assets now pay your bills, not your job. Generally, this happens when your investments reach about 25 times your annual spending needs.
And your portfolio at this stage might be that preservation mix, stocks and bonds.
Likely, yeah. Maybe that 7525 VTSAX VBTLX split or whatever fits your risk tolerance held across your various accounts.
So the 4% rule, where does that come from?
The Trinity study, famous research from the late 90s, they looked back historically and simulated withdrawing a certain percentage of a portfolio each year adjusted for inflation. They found that a 4% initial withdrawal rate had a very high success rate, like 96% of lasting at least 30 years.
So withdraw 4% the first year, then adjust that dollar amount for inflation each year after.
That's the basic idea. But the book also highlights a really interesting finding from the study's data, looking at how much money was typically left after 30 years. Portfolios with more stocks, like 100% or 75% even while withdrawing money, tended to end up with significantly more wealth remaining after 30 years compared to portfolios with fewer stocks, like 50-50.
So stocks aren't just for growth, they help preserve wealth long term too.
That's the powerful implication. They help the portfolio keep pace with or beat inflation over decades, even during withdrawal.
But the book doesn't advocate sticking rigidly to 4% no matter what.
No, it critiques that. Calls it nuts to blindly take out the same inflation-adjusted amount if the market just crashed 30%. Common sense should apply. If your portfolio takes a big hit, you might need to temporarily tighten your belt, just like if you took a pay cut.
And if the market does great,
maybe you can spend a little more that year. The key is sensible flexibility. Reassess annually, look at your portfolio value, look at your needs, and adjust. The author mentions their own approach is flexible, not tied to a strict schedule.
how do you actually get the money out?
Simple enough with places like Vanguard. Log in or call, sell the necessary shares, transfer the cash to your bank. Easy.
What about other income sources, like Social Security?
Briefly covered, it's funded by payroll taxes held in trust via treasury bonds. The main decision is when to start taking at age 62 for smaller checks, delaying up to 70 for bigger ones.
How to decide?
Based on your need for the money, your health and life expectancy, break-even is often mid-80s, and spousal survivor benefits. Basically, play the odds based on your situation.
Is the system going broke?
The author isn't worried for older folks, 55 plus, citing the political power of seniors. Changes are likely for younger generations, maybe higher retirement age, slightly lower benefits, but not a total collapse in the foreseeable future.
Is Social Security a good deal financially?
Probably not for someone following this simple path. You'd likely do better investing those taxes yourself. But for society as a whole, preventing poverty, yes, it serves a vital purpose. Nuanced view.
Okay, that covers managing the wealth itself. The last section seems broader advisors, giving, living richly.
Yeah, Section 6 looks beyond just the numbers, and it starts with a very strong opinion on investment advisors.
Which is?
Avoid them, pretty much universally.
Okay.
This includes money managers, brokers, insurance agents acting as planners. Anyone making money by handling your money.
Why such a strong stance?
A fundamental structural conflict of interest. Advisors generally make more money selling complex, high-fee products than simple, low-cost ones like index funds. What's best for their income often isn't what's best for your wealth.
How do they make money in ways that hurt investors?
Commissions, or loads, are one way. A percentage taken right off the top every time you buy or sell. A 5.75% load means nearly 6% of your investment is gone immediately. Vanguard funds don't have these, but many advisor-sold funds do. Obvious conflict.
What else?
Fees based on assets under management, AUM. A percentage of your total portfolio charged every year, maybe 1-2%, sounds small, but the book calls it a devil's ball and chain. Compounded over decades, it destroys a huge chunk of your returns. Compare 1% or 2% plus fund fees to VTSAX's tiny 0.05% expense ratio. The difference is massive over time.
And index funds threaten this model.
Absolutely. Because indexing is cheap and effective, it makes high advisor fees harder to justify, so they often have to downplay indexing or promise elusive outperformance to keep clients paying.
So the advice is just DIY with low-cost index funds.
That's the core recommendation for the simple path. Avoid advisors. The Am I Warren Buffett? Logic applies to picking advisors too. It's incredibly hard to find one who is both truly skilled and aligned with your interests.
Are there any good ones?
The book is skeptical. Maybe a few exist, but they're rarer than baptized rattlesnakes. And even well-intentioned advice can be bad if it's overly complex or expensive. It's a field, sadly, that attracts cons. Madoff is mentioned as the extreme.
Okay, strong warning there. What about giving money away?
Discussed not as an obligation, but as something that can bring real personal pleasure. There's a nice anecdote about gifting a fancy dinner to some teachers. The joy came from facilitating that experience for others.
Are there smart ways to give? Tax advantages.
Yes, tax deductions usually require itemizing. For people who don't itemize or want more control, the author recommends donor-advised funds, DAFs, like the one Vanguard offers.
How do DAFs work?
They're not just for the super rich, $25K minimum at Vanguard. You contribute money or appreciated assets like stock to the fund and get the tax deduction that year. If you donate appreciated stock, you get the deduction for the full value and avoid paying capital gains tax on the growth, a double tax win. The money in the DAF can then be invested and grow tax-free. You decide later which charities get grants from the fund and when. You control the timing and recipients. It also shields you from endless solicitations.
Any other tips on giving?
Concentrate your giving for more impact, avoid phone solicitors, and research charities, Charity Navigator mentioned, to ensure they're efficient and legitimate. Also acknowledges direct help to friends, neighbors, not tax deductible, but immediately impactful.
The final thought on giving.
It's fine, it can be rewarding, but there's no moral obligation. Be wary of anyone telling you otherwise.
Okay, which brings us to the ultimate goal. Living a rich, free life.
This is the why. The most valuable thing money buys is freedom. Freedom from worry, freedom to choose your path. Endless possibilities, limited mainly by imagination and fear, not money.
There's some inspiring stories here about Tahiti.
Yeah, great examples of people living boldly. One about a guy named Muck, who, with friends, took over a cheap pineapple farm and then a half-built hotel, despite zero experience. They just had courage and a reputation for getting things done. They succeeded, got rich, lived simply in paradise. The point is about action, defying limits.
And the sailboat partners.
Two guys shared a business in LA and a sailboat. They'd literally rotate. One runs the business while the other sails around. Required huge trust, but what a way to balance work and life. Creative solutions enabled by financial flexibility.
So these are examples of breaking free.
Exactly. Breaking free from debt, consumerism, limiting beliefs, living lives driven by purpose and courage. That freedom is the reason for following the simple path.
Any last thoughts on risk?
Briefly addresses those big existential worries, asteroids, zombies, basically dismisses them as highly improbable for practical planning. Focus on the real risks this path helps you manage. Debt, bad decisions, complexity, high costs.
And it wraps up with summary advice, almost like a checklist for someone young.
Yeah, distilling the whole path. Avoid debt. Build your career skills. Live below your means. Save aggressively, 50% plus. Invest consistently in low-cost to index funds, VTSAX. Max out tax-advantaged accounts, match first. Do this for 10-15 years.
The outcome?
By your early mid-30s, you're likely well on your way to FI. Assets are growing fast. Stick with simple VTSAX while accumulating. Maybe add bonds after you stop working for a smoother ride.
And once you hit FI, 25x spending.
You can loosen the purse strings a bit, but keep spending around that flexible 4% guideline. The final message is really empowering. You can do this. It takes discipline, but the payoff, a life of freedom and expanded options, is immense. The future is bright if you follow the path.
So that brings our deep dive on the simple path to wealth to a close.
Yeah.
It really hammers home that wealth and freedom often come from simplicity, not complexity.
Absolutely. Avoid debt, spend less than you earn, save a lot, invest consistently in low-cost, broad index funds, and crucially, manage your own behavior and ignore the market noise.
This exploration hopefully gave you a clear picture of that roadmap. It really boils down to making conscious choices, choosing freedom over consumerism, simplicity over complexity.
It's a powerful framework.
So, thinking about everything we've unpacked, the pitfalls of debt and complexity, the power of indexing and saving, the importance of mindset, here's a final thought for you. If financial freedom truly is the most valuable thing money can buy, what would you genuinely do with that freedom? What choices would it open up for you?